Hello and welcome to the monthly recap. This is for the month ending today, September 30th, 2025. The year's officially three-quarters of the year way over. Like, absolutely mind boggling. We only got 3 months left in the year. Pretty shocking. So, joining me today, so you're all familiar with Finn, the Irish setter, but next to him, I guess over here, is our new addition to our family. His name is Archibald. He's a Cavalier King Charles Spaniel. He is 10 weeks old. And what you're seeing right over there is a huge step in the right direction. For the most part, Finn has been waiting for Archie to leave and asking when he's going to go home. We're on like week 2 right now, and he's just starting to barely warm up. But what you're seeing here is a huge step in the right direction. Thank all that is holy. It's been a little high escalated tensions around my house lately as poor Archie just wants to find a friend, and both dogs resent him with a white hot passion. So this is a good day in the Staufer household. You guys are all witnessing it first. The family that naps together stays together. So all right, so let's get into it. September was a really busy month, a really busy month. We're going to be talking about the labor market. It's starting to come into focus. Okay, there were some changes made at the very top of the BLS as the administration fired rather the head of the BLS. And while that one action alone does not fix the underlying issues within BLS, issues with reporting, a lot of projections, a lot of modeling, it doesn't fix those issues, but changes had to be made. I think that's probably for the best. Maybe not necessarily the way they went about changes, but at least it's a step in the right direction. Change is a good thing when the issues within BLS have been just so wide ranging and poor. Anyways, labor market's starting to come into focus. Going to be looking at that a little bit. Inflation has been coming in mostly as expected, which is good news. Everybody was worried it was going to be a runaway train. Things are going to get really out of control. So far, that does not seem to be the case. It's going to get worse before it gets better, but at least it seems to be coming in similar to expectations. To talk about that. Fed meeting, huge Fed meeting. The Fed finally cut rates by 0.25%. Thank all that is holy. What was really interesting within that Fed meeting, though, because it was a meeting associated with a summary of economic projections, where they don't just release what they think is good, what their decision is on the rate, but they actually have to show their work, so to speak. They have to show where they think GDP is going, where they think unemployment is going, where they think inflation is going, where they think the Fed funds rate is going. And that last one, where they think the Fed funds is going, is extremely interesting. You're going to be spending a fair amount of time on that. GDP, it's coming in surprisingly resilient. That's really good news for the economy as a whole. It's going to be really interesting when we get the advanced look for Q3 GDP, which is going to come at the end of October, because I've talked about it before, how there's this pull forward effect. People were worried about tariffs, and they moved up some of their purchases. So we saw two very different numbers from first quarter to second quarter. What's the third quarter going to look like? It's going to be very interesting and telling. Mortgage rates as a whole, they ended the month around 6.375%. That's for a first-time home buyer making less than 120% of the area median income. One of those kind of ideal scenarios, but around 6.375%. Refinance rates are going to be a little bit higher. Investment property rates are going to be higher, but for that ideal scenario, right around 6.375% today. In the lead up to the Fed rate cut, mortgage rates did improve, and they improved by around 0.5% to 0.625%. Okay. Then what happened when the Fed actually cut rates? Mortgage rates actually jumped a little bit. They actually jumped by about 0.25%. Why would that happen? Well, markets are forward looking. Okay. They call it buying on the rumor and then selling on the news. And that's exactly what traders did. Okay. So they knew the Fed was going to cut rates from based on what the Fed was saying, based on the projections, based on everything else. They knew the Fed was going to cut rates at their September meeting. And sure enough, they did. So traders start to buy up mortgage-backed securities. And then the second the Fed makes that decision, they start to sell off those mortgage-backed securities. And rates actually ticked up once the Fed did cut rates. It's not the action itself of the Fed cutting rates that caused rates to jump. It's everything in the lead up to it, mortgage-backed securities being bought, and then the actual action is when the traders took their profit from the market. So that's kind of what we saw happen. We saw the exact same thing happen a year ago when the Fed cut rates as well. All right, so let's get right into it. Let's start with the biggest punch bag of them all, BLS, Bureau of Labor Statistics. Okay, I've talked about before how it really should be knowing the BS report because the numbers have been just so unreliable. So unreliable that the administration, as I said, fired the head of BLS. That in and of itself doesn't fix the issues, but it's a step in the right direction because changes certainly had to be made there. The numbers that economists use for rather large decisions like deciding whether to cut rates or not is based on the numbers. So you can't have a bad input or else it's going to equal a bad output. And we were getting a lot of bad inputs and bad outputs from the BLS. So BLS report for August, it reported only 22,000 job gains. 22,000 job gains for the month of August. That is a ridiculously low number. Okay. It was also below expectations of 75,000. Yes, the numbers are a little bit more reliable now, it seems. But they're not good numbers. It's still a very softening, weak labor market. The unemployment rate did tick up to 4.3%. Now, talking about the unreliability of the numbers, like it's a very easy thing to pick on, right? Well, they also released this report, and it shows real data. So the BLS report itself is modeling. Okay, they report these on a monthly basis. We're going to be getting another report for September at the end of this week. Government shutdown may impact some of that timing, but we're going to get those numbers at the end of this week for September. Every month when the BLS reports these numbers, they're based on modeling. Okay, they do some household surveys. They look at how many businesses were created and how many businesses died, and they try to project how many jobs were gained during the course of the month. It's really hard task to do, no way around that. It's also extremely volatile and variable, and the numbers have been really unreliable coming out of this report. But at least the last 2 months, we've seen less revisions compared to prior. So maybe some changes are starting to occur. It could also just be an entire fluke, and we're just kind of, whistling past the graveyard and ignoring the underlying issues. We shall see. Time will tell. But when we get the QCEW report, it shows real data. No longer projections, no longer modeling, but real data. The problem is it's in the past, okay? And since it's in the past, it doesn't get a lot of jump from the markets. The markets don't really rely on that information too much because it's old data, okay? But March of 2024 through March of 2025, they reported 911,000 fewer jobs being added than were initially reported. So that's like 72,000 less jobs per month. When I talk about the BS report, that's why. Like, you can't have these numbers that economists rely on be so horrendously off target. I mean, sometimes missing numbers by 50% or more even. It's just good luck trying to make broad economic decisions with that unreliable data. But from the Fed, when we looked at their Fed meeting, okay, so this is the first piece of data from the Fed meeting, we get this distribution of participants' projections for the unemployment rate. That's Fed speak for where do the Fed members think unemployment's going to be by the end of the year. Okay, so this is for 2025, so this is by the end of the year. Unemployment rate is currently at 4.3%. The dotted line here is the June projections, and the September projections are the dark blue bar itself. Okay, so what we see is not a lot of change from the June meeting to the September meeting. Those lines almost match up identical. They are predicting the unemployment rate to end around 4.4 to 4.5%. So they're expecting this 4.3% to get worse. Okay, that's the first thing from the Fed. Okay, yeah, we do expect unemployment to get worse by the end of the year. That is an admission from their end. It's also one of the big topics that they talked about, which I'll address in just a second here. On the inflation front, inflation has been coming in fairly in line with expectations. We got a little bit of good news from PPI, Producer Price Index. That's the wholesale inflation. That's business level inflation. Headline came down negative 0.1% last month. Yearly went from 3.3 to 2.6%. That's great news. Core inflation came in also down negative 0.1. Yearly went from 3.7 down to 2.8%. Those are some significant swings. Like, normally you'd expect me to pop some confetti and throw a party because that's such a significant move downwards on inflation, and mortgage rates hate inflation. However, okay, Aaron's always for every frown there's a smile. However, this is PPI. Okay, producer pricing. It gets the least amount of respect from anybody. Okay, it's possible businesses could take that reduction in costs that they're feeling and pass it along to consumers and have consumers save money. It's also entirely possible they keep the price of goods the same and they just increase their profit margins, right? There's more than one way a business can deal with cooling down of costs. Case in point, when we look at the consumer price index, okay, which is consumer level inflation, the headline came in up 0.4%. The yearly went from 2.7 to 2.9. So it did worsen. The core increased 0.3%. Yearly did remain stable at 3.1%. So again, businesses are feeling cooling of costs, but that's not necessarily being passed along to consumers. Um, it's interesting because previously we had also gotten some data that showed that businesses were splitting the cost of that increase in cost of goods due to tariffs with the consumers. So they weren't passing it all on to consumers. So maybe they're just trying to claw back some of the profits that they otherwise had been passing off to consumers by keeping prices somewhat stable. So it's going to be kind of interesting to see what happens from here. But CPI, Consumer Price Index, pretty much in line with expectations. Not a big change there. It did heat up, but it was also expected to heat up. So pretty much in line with expectations. Personal consumption expenditures. This is the Fed's favorite measure of inflation, PCE. Headline came in up 0.3%. The yearly increase from 2.6 to 2.7%. Again, pretty much in line with expectations. The core rate increased 0.2%. Yearly remains stable at 2.9. If the Fed cared about one number, it's this bottom one right here, this core number right here, core PCE. And that's what we have on the right side, again, from the Fed's meeting. So what you see again in the June projections is they were expecting inflation to be a little bit hotter by the end of the year. Okay. But when they met just, last week, September, all of a sudden they cooler. So they're expecting inflation to be a little bit more stable, a little bit cooler than they were expecting just a few months ago. That's good news. And again, it points to, somewhat reliable, predictable inflation figures. It's not a runaway train that they can no longer reel in. It's now coming in line with expectations. The train is finally running on schedule. Huzzah, we'll take it. Yes, they want this 2.9 to get down to 2%, but they're also recognizing that it's going to take some time. And what they're really recognizing is this. They're recognizing that they've been focusing too much on inflation. Okay, they admitted that. They said, look, due to the changing of risks, what they're really saying is we need to pay more attention to the labor market. Okay, the labor market is showing signs of weakness. The labor market is showing signs of concern for us. The unemployment rate's taken up. The BLS numbers have been wildly erratic, and the last couple of reports have been very mild. We need to pay more attention to the labor market, less attention to inflation. Okay. And that's why they felt empowered to cut the Fed funds rate. They cut the Fed funds rate by 0.25%. It's now in a range of 4% to 4.25%. Now, the Fed funds rate, that is the rate that banks, lenders exchange money with one another at. Okay. It is not the rate that affects long-term debt. It's really the rate that affects short-term portfolio debt. And by that, I mean credit cards, car loans, personal loans, student loans to a lesser extent, your savings deposit, okay, whatever rate you're getting paid for having money stocked away in a credit union or bank, that is also going to get reduced. Okay, so short-term portfolio, it does not affect long-term non-portfolio debt like mortgage-backed securities. Over time, they tend to trend in the same direction, but one does not directly impact the other. Okay, they acknowledge their policy has been restrictive. Rates have been elevated for a longer period of time than we expected. They also hinted that there's room for more cuts. Okay, they acknowledge that the focus has been too much on inflation. They need to shift their focus towards the labor market. Now, those two things are kind of impacted by the same thing. So when the Fed cuts rates, it can cause inflation to tick up, but it can also free up capital for employees or employers to hire more employees. So it can help the labor market. So they've got these two opposing factors. They want to maintain price control, and they also want to maximize employment. And a Fed rate cut will worsen inflation, but help out the labor market. And vice versa is also true. So it's a little bit of a tricky dance that they've been doing. It's a very tricky job that they have in front of them. So far, so good, I would hope and see. So the Fed expects changes by the end of the year. They are expecting unemployment to rise to 4.4 to 4.5%. Currently, it's at 4.3%. That's an acknowledgement that the labor market has been struggling. They want inflation. They're expecting inflation to be around 3%. Currently at 2.9%. So they are expecting that to get worse before it gets better. Their long-term goal with core PCE is 2%. And then GDP. They're expecting, this is probably the biggest change from their projections in June. They're expecting that to now increase 1.6%. For the year. That's up from June prediction of 1.4%. So that was a pretty significant change there. The Fed anticipates a rise in unemployment and inflation in the next few months. They're expecting both of those things to be true, but they're also expecting the economy to perform better than previous predictions. The tariffs were the big unknown, and again, businesses have been splitting the cost with tariffs. We haven't seen a direct impact on a lot of the cost of goods with tariffs. Everybody keeps waiting for the shoe to drop, and maybe it still will. But so far, it hasn't been having the wide-ranging effect that a lot of people were expecting. All right, so this is probably the most fascinating part from the Fed meeting. So, what are the expected cuts that are still to come? Okay, so this is the Fed's dot plot. It gets a lot of media attention when it gets released, and it gets released at any of those meetings associated with the summary of economic projections like we just had. Okay, so the Fed rate currently is in this range right here, 4 to 4.25%. Okay, so there's 6 members currently expecting no rate cut. 2, 4, 6. There's currently 6 members expecting no further rate cuts. Okay, there's one dot up here. I'll address that in a second here. There's 2 members that are expecting one more rate cut by the end of the year, but the bulk, okay, 9 members are expecting 2 additional rate cuts by the end of the year. So 9 members are expecting 2 additional rate cuts by the end of the year. That's interesting because we only have 2 meetings left. So they're expecting 0.25% at each of the next 2 meetings. They could also just do half at one and call it a day, but more than likely it would be 0.25% at each meeting. Now, there were 2 outliers I want to address, and that's this dot and that's this dot. Okay, so this member up here, they did not want to cut at the meeting. Okay, so that's why they're predicting a rate that's lower than or higher rather than currently exists, because they did not want a rate cut at all. They finally fell in line with voting, and once the vote actually became official, they said, okay, fine, I'll vote for one rate cut. But they did not want a rate cut at all. They were perfectly happy leaving rates as is for the remainder of the year. And then what is going on down here? Stephen Mirren, the newest member, they dissented. Okay, they dissented. They favored a 0.5% cut, so they were not happy with the 0.25% cut. Not only that, but they want to see 1.5% in rate cuts by the end of the year. That's extremely aggressive. Honestly, probably part of that was a little bit political in nature. Okay, they want a permanent position on. There's no permanent positions. Very few permanent positions. They really wanted like a longer term position on this voting panel. So they're kind of staking their claim and trying to make a statement in a way of saying, hey, look, I dissent and I want 1.5% cuts. It's pretty outlandish. It's really, really, really dovish. It's like ultra dovish. But it was as much of a political show as anything else, probably. The leading prediction, though, and this is important, is 2 rate cuts by the end of the year. Again, 9 of the members are of that opinion. There's another 2 that want 1. And then there's, again, the outlier that wants 1.5% of cuts by the end of the year. So the Feds took a step in the right direction. Their members left the door open for additional cuts. And the majority opinion is now 2 more cuts by the end of the year. We'll see if that comes to fruition. But again, step in the right direction, one of several cuts most likely happening. Let's talk about that GDP figure again real fast. So Q1 came in extremely mild, negative 0.5%. Q2, in the previous reading, it was 3.3%. Okay, and that was a huge swing. We all thought, wow, what a change from Q1 to Q2. Well, we got the final reading of Q2 GDP, and that came in at up 0.8%. So it came in even hotter than it was expected. Again, the Fed's acknowledging a pull forward effect. People and businesses moved their purchases forward to the beginning of the year because they were scared of tariffs. And then Q2, they were offloading that inventory that they had stockpiled, which caused GDP to tick up. So it's a little bit of a mixed bag. It's going to be very, very interesting to see what happens in Q3. Q3. It's going to be a very telling number. Is that pull forward effect officially over? Are we still seeing signs of that? Is it like the first balance number we get all year long? It's going to be very interesting to see. More on that in just a second here. When seen together, though, GDP is around 1.65%. And the Fed did come out and say, look, that is the right approach. We should not look at each of these quarters independently. We should really look at them in combination with one another. When we look at the June projections from the Fed meeting, the dotted line again, they were much less optimistic on GDP initially. And this September meeting, they're like, yeah, no, honestly, GDP is doing pretty well. That was probably the biggest shift from June to September is the Fed's expectations for GDP. Looking ahead. So the Fed has 2 more meetings, October 29th. So, wow, can't believe it's going to be the end of October already. But by the time we come out with another video, we'll have another update on the Fed meeting. It's going to be a shorter one because it is not a meeting associated with the summary of economic projections. So they will have the rate decision. They will have a press conference after the fact, but that's about it. They're not going to have any of these other graphs or dot plots or any of that stuff. The next one of those will come in December, December 10th. So no meeting in November. These are kind of the next 2 opportunities for the Fed to cut rates. Again, right now, the prevailing opinion is 2 more rate cuts by the end of the year, probably 0.25% at each. That would be the biggest bet on best Vegas line if there was gambling odds on this is probably a 0.25% each in the next two cuts. All right, let's look ahead. What does October have in store? The biggest one is the government shutdown is looming large, and that could literally go into effect like midnight tonight. The government has different ways and different levers that they can pull to temporarily extend some things, tap into reserves to fund things. But a government shutdown, it could very well be the case by the time you're watching this video. It could very well be the case, 24 hours from now, that the government is officially shut down. What would that mean? Furloughed government employees potentially, shutting down of national parks eventually. At least on Colorado's side, our governor has come out and said, like, we'll tap into funding and keep those open if we need to, but we'll see. Expect possible delays at the airports for air traffic control. We've all been through this before, and historically, government shutdowns don't last very long. Knock on wood, hopefully. Be ready for news on that front. It's going to start to come very fast and very heavy. Another Fed meeting, end of October. Great. Another opportunity to cut rates. Likely going to be a 0.25%. We shall see. Advanced estimate of Q3 GDP. Now, the advanced estimate, it's not really reliable. Okay. It has a lot of revisions that happen after the fact, but we will be getting the first reading, the advanced estimate of Q3 GDP at the end of October as well. Some of this reporting could be delayed depending on whether or not the government shut down. BLS reports could theoretically be delayed if there's a government shutdown. So we shall see. Labor market continuing to show signs of weakness. What is the latest BLS reports? We don't have to wait long for that. Only a few more days. And then when does the rate cut begin to show up in the labor market, the economy? That stuff takes a long time to actually start to filter down through the economy. It's going to be very interesting to see when we actually start to see signs of that popping up. All righty. I think that is it. I hope you all have had a wonderful month. I hope you have a wonderful October ahead of you. From Finn, Archie, and myself. I can't believe you made it through the entire video. That's so good. All right. I appreciate you all so much. Have a wonderful rest of your week. Have a wonderful month, and I will see you next time. Thanks so much. Bye.